For more on today's CPI print, Societe Generale head of U.S. rate strategy, Subadra Rajappa, is here on set. Subadra, great to see you. What did you make of today's action? I know you're not on the equity side of it, but to see markets rally to record highs and to see not too much happening in the bond market in terms of by the end of the day, what did you make of it all?
So to me, if you came into this report thinking that goods inflation is going to show up, tariffs are going to show up in goods inflation, you just didn't see it. I mean, you saw a modest increase in goods inflation. Services inflation was, broad-based gains. So to me, that is a bit of a concern. And I know you were talking earlier about whether the Fed should be cutting 50 basis points or whether they should be cutting 3 times this year. My view is that they should cut maybe once, maybe twice this year, given the fact that inflation is a concern. This is just the beginning of the feed-through from tariffs into inflation. And it's only going to start ramping up in the second half of the year. So this idea that you should be front-loading cuts in this environment doesn't make a lot of sense. And to your point earlier, I mean, financial conditions are extraordinarily easy. Today's price action, shows exactly that, is that the market's still looking at aggressive path of cuts, and equities are responding.
You speak very rationally, and that is in the rational Fed world, the rational Fed dynamic. But we have the political overlay, the possibility that Stephen Myron may be, appointed and confirmed, I should say, to join the Fed. We have the possibility that we've got a bunch of governors who are basically auditioning for the part of Fed chair as well, who will probably want to flex their very dovish views at this point. So how do you overlay that with what you think the Fed should actually do if it is bound by the dual mandate?
So I think ultimately reason will prevail. You're looking at a committee that's making a decision. Yes, you're going to have more dovish leaning members in the committee going forward, but that doesn't really change the dynamic that you're going to need to have to build consensus across, a variety of not just governors, but also Fed presidents who are going to be voting. So I think ultimately reason will prevail, and they will, probably cut rates. But again, a 25 basis point rate cut is not a lot for the market. And my concern is that if they do cut rates by 25 basis points, and let's say the 10-year yield actually moves higher, that's not going to do a whole lot of good for the mortgage market or other markets that are interest rate sensitive. So they're going to have to weigh the pros and cons of being aggressive on policy.
Let's just go back to tariffs for a second. So how much or how little, it sounds like, of tariffs do you think we've seen already? And given that some of the tariffs have been sort of delayed, and so the start time hasn't really worked through the economy yet, one could argue, and that would be a very reasonable argument. Where are you thinking that pressure will be ultimately when it's fully felt?
So it's actually a very confusing picture on tariffs. You are seeing some components of, showing higher prices, for instance, electronics, apparel is, of course, a bit volatile, footwear. Those prices went up, so that could be related to tariffs. But really, a lot of that could be absorbed by the corporations. So to get a picture on what's happening, you need a few more months. Earlier on, I think corporations are going to absorb the costs. Over time, they're going to push back. They're going to pass those costs on. For instance, groceries. I mean, there's very little margin there. They're going to, your tomato prices are going to go up because they can't really absorb those prices. It's just a matter of time that the tariff-related inflation starts to show up in the data. I think it's still a little too early because we just don't know how much the tariff rate is going to be ultimately when the dust settles.
Well, Subadra, fortunately, Tim grows his own tomatoes, so he doesn't worry about that.
I do. Why are you joking about that?
I'm not joking about it. Do you see it? Do you see me smiling here? I think you're
anyway,
correct.
Your question to Subadra.
My question is, where 10-year yields going? Because that supercore number was hot. The market obviously, maybe it was paying attention to it in the form of the bond market. 10-year yields up a little bit. Are they just sort of stuck in the mud here, or are they headed higher or significantly lower?
I hate saying this, but I think almost everywhere in the yield curve, 10 years in is kind of stuck in a range. I think the 2 years probably going to be between 3.5% and 4% because the market's already very efficiently priced in for a very aggressive policy easing path. 10-year probably between 4 and 4.5%. And the 30-year to me is a little bit more unhinged because that's more dependent on what happens globally. If global bond yields start to rise, the 30-year starts to take off, then the 30-year in the Treasury market is also going to rise. So I think the 10-year probably stays, pretty range bound for the remainder of the year.